Welcome everyone. We'll get started here in about a minute to 2 more minutes. Let some more folks join before we introduce our speaker and turn over the session to Professor Baier. All right, Scott, you don't mind if we get started?
No, sure.
All right, do a quick introduction. Good afternoon. Welcome to the Foundation for Teaching Economics webinar on the current state of the American economy. Today's talk will highlight some new data and trends in the U.S. economy. I'm Ted Tucker, Executive Director of the Foundation, and it's my pleasure to introduce our speaker today, Professor Scott Baier. Professor Baier is currently the chair of the economics department at Clemson University. In addition, he served as a visiting scholar with the Federal Reserve Bank in Atlanta and was a senior economist on President George Bush's Council on Economic Advisors. Professor Baier's research interests focus on understanding the causes and consequences of globalization and the economic impact of free trade agreements and economic growth. His knowledge of economic data and where to find it makes him an astute observer of the American economy. He's also been a longtime instructor in our Economics for Leaders program, and I'm grateful for him giving today's presentation. As with usual with all FTE webinars, we'll have a recording of this webinar as well as Professor Baier's slide deck posted on the FTE website in a day or two following the conclusion of his presentation. After his talk, we try to put together or have about 10 to 15 minutes for questions. And we ask that you use the Q&A feature for submitting questions. And then following the webinar, we also ask that you complete a short evaluation on today's presentation. Also, I should add that Professor Baier is suffering a little bit because Clemson is not doing so well this year. So please forgive him if he's a little dour. So Scott, go ahead, take it away.
All right, okay. Thanks, Ted. Thanks for the introduction. Welcome, everybody. So I think the talk I'm going to give is going to be, what screen did I just share? The wrong screen. Let's try this one. Okay. I think today's talk is going to have some similarities to talk I've had before, but I also wanted to pitch it a little bit different this time. And for the last year or so, hanging over, I think everybody's head is are we heading into a recession? And that seemed to be a little bit surprising because month after month or quarter after quarter, the economic data seemed to be a lot better than what we were talking about on the news. So what I'm going to do is try to provide some insights into what I think is going on and why that was the case, and again, where we stand currently. So again, kind of a quick summary of what the talk is going to say today. And again, there are a couple key moments coming up again that's going to provide us some more insights of what the state of the economy is, or what our policymakers think about the state of the economy. In particular, just around the corner, from October 31st to November 1st, that's a typo there, the Federal Reserve is going to meet again, and there's going to be some discussion on whether to raise interest rates or not, or raise the targeted federal funds rate. It almost seems as a foregone conclusion that given the direction that inflation has had and given the state of the economy and the labor market, they're likely to hold interest rates steady. But nonetheless, it'd also be important to see what they say about why they kept the interest rates constant, and again, what they see in when they read the tea leaves of the most recent inflation numbers. if you're looking kind of back a little bit in the rear view mirror, kind of one of the biggest indicators or most important indicators of kind of the health of the economy is how income grows. And of course, GDP is our measure of aggregate income growth in the economy, or real GDP growth. Real GDP growth in the second quarter of this year was revised down just slightly, down to 2.1%, following a 2.2% increase in the first quarter. Tomorrow morning at 8:30, tune into your local favorite business channel, because the Q3 GDP growth comes out. And by most expectations, the average kind of expectation of what GDP growth is going to be for the third quarter is 3.4%. The median is 3.5%. And for those of you who pay a lot of attention to this, this GDP growth and forecasting, the Atlanta Fed keeps almost a running number of where they think the GDP is going to be, and their prediction is it's going to be as high as 5.4%. So those numbers are very large for recent historical standards, and I'll talk about that. In fact, if it came in at 5.4%, that would be about as large as what we saw in the early bounce back coming out of the pandemic. As I already mentioned, inflation continues to trend down, either through the action of the Federal Reserve and also through other kind of, as the economy heals from some of the distortion it had coming through the pandemic and the growth coming out. I think both of those factors are leading to inflation coming down, but there's still some issues left that I think the Fed is concerned about, and we'll look at those later as well. And then we'll also talk about the labor market. The labor market continues to add jobs, but I think, again, one of the things that has the Fed willing to, again, keep the pause button on in terms of the federal funds rate is the last couple of job reports have indicated that the labor market is not quite as overheated, as we would say, as it was earlier in the year. So those are kind of the main punchlines that I'm going to talk about in this talk. Of course, looking forward, there could always be events occur. There are some headwinds that we're facing. We don't know what might be happening again as conflicts continue in both Europe and in the Middle East. So those things can always impact what's happening with GDP. But as of right now, I think the numbers seem to be doing better than what the national talking heads have been saying for the last year or so. So again, if we do that quick look at what GDP is, again, GDP is this real GDP number is a measure of income and production. It actually captures both. And this is kind of a common slide, but I'm going to add a little bit different, something new, I think, in the upcoming slides is if you look at GDP from 2000 up to what was the Great Recession, as I've mentioned a couple times in kind of standard slide of my talk, the recovery from that Great Recession was an L-shaped recovery, is that we dipped down and we never bounced back up to the previous trend that we were on prior to that. But if you look at what we did coming out of the pandemic, that was a V-type shape recovery. And again, we hit it, we dropped down very rapidly, but bounced back up kind of rapidly, almost back up to that trend line that we've been on since 2007, 2008. What I'm going to talk about a little bit, because I haven't focused on this much, and I think it's worth bringing up. A lot of times when you're in a macro class or thinking about the macro economy, we talk about GDP growth in cycles. That is, how are we growing over time, and what do recessions look like? Most of the talks have seemed to be built around fluctuations around that trend, but I wanted to spend a few slides talking about that growth trend and in some of the fundamental maybe problems or differences of what's different about the economy post 2000 than say from 1950 up to 2000. When we think about GDP, in the long run, economic growth is the norm. That typically the economy grows each and every year, and there are several reasons why it grows. And it's mainly coming from the supply side factors. So over time, supply side factors drive growth that primarily comes from the growing labor force, a labor force that not only is growing in size, but it's growing in skills and experience. Those things have helped increase GDP over time. And then, of course, you have businesses investing in plants, machines, and equipment. This increase in productive capacity has led to increase in GDP growth over time. And then kind of the last thing underlying all this is you have improvements in technology, productivity that make workers and capital more productive. So those are the long run real drivers on the supply side that lead to increases in kind of our overall well-being through increases in real GDP growth. But again, when you look back at what has happened, since, say, 1947, where I now depict real GDP growth, again, I've drawn in that trend line. And what you can see is with that trend line drawn in, that even this goes up to 2000, I haven't extended it yet. What you can see that there are clear fluctuations, expansions and recessions, but we have a tendency always to move back up to that trend line. Beginning in about 2000, it's the growth rate of the economy deviated quite dramatically from that long run trend line. So you can think of the gap. If we could have been growing like we have been on average, this would be our GDP, but this is our GDP this year. So that's a current difference in income. And, that's about $7,000, $8,000 per person. And if you add it up every year, that's quite a lot of income lost. And one of the questions I think, we should ask ourselves when we're thinking about macro issues is why have we been growing at a slower rate, say, the last 20 years? So again, a different way to look at it. And again, I'll show two quick pictures here. I could look at it in terms of a bar chart with columns. And anytime you throw in pictures with the pandemic, what you're going to see is those pandemic numbers, the big drop and the bounce back are really going to distort the graph. So a lot of the pictures, if I forget to say it, I'll cut out those few months of the pandemic just because of how much they distort things. So if you remove that period, and we all would like to remove the pandemic in our minds in some ways, this is what GDP growth has been over time. And if I draw in what has been the long run average from 1947 up to 2000, on average, real GDP growth has grown about 3% a year. So if you kind of look at that chart with that line drawn in at 3% a year, you can see in most periods, we haven't got up to that long run average. And so again, only 36% of the time we've had over 3% growth. And a lot of those numbers coming out of the pandemic, where part of that was the bounce back growth. So again, really not so great economic performance in terms of economic growth over the last 20 years. And then the question we ask is why this underperformance? And I think a lot of study is going into that. And some of the reasons are, and maybe straightforward, is perhaps some of that low-hanging fruit is gone. Say, if you go back to 1930, we had a smaller population. It was less educated. Fast forward to 2000, you had a bigger population. Most of it was educated, had a high school degree, some college degree. The additional amount of education skill that we're likely to get is not going to likely add as much to GDP growth. So some of that early growth in terms of education and some capital accumulation that were relatively easy to attain are much more difficult now to make advances in. There's been a notable for lower productivity growth for one reason or another. Again, that requires some explanation. Some of the growth, slowdown in growth, could be changing demographics. At the heyday, we had the baby boomers in the kind of in their mid careers, gaining experience, coming in with a lot of knowledge, and that was helping push forward GDP growth. And of course, there's other things that I think are more controversial, but certainly plausible in terms of impacting kind of this performance of GDP growth over the last, say, 20 years. And it could be taxes and regulation, inequality, different public policies, kind of the splintering in some sense of the two parties in DC and a fractioning of the population. Those are things that could have slowed down the growth. But this is a real big concern, I think, that often doesn't get addressed in these talks, but it's important to think about, because that slowdown in growth in many ways, that income that we would have dwarfs some of the income loss that occurs during a recession. So those are important things to think about. Again, going back to what we typically are worried about, and I think what draws a lot of people here is the idea of GDP and cycles. Are we heading into a recession? And typically, and again, the way you could think about recessions, and the way I'll frame it here, is what causes recessions. Usually they're things that occur on the demand side. They're results of imbalances in the economy, whether they are man-made, natural, but they usually lead to imbalances in one sector, overconsumption, overproduction, overinvestment relative to other sectors. So what this does in one area, you might get what we often refer to in the Great Recession, is you had that housing bubble, but it can also lead to, when it collapses, what you'll have is a slack in output. And then one of the issues what drives that is these large shifts in demand causes increase in housing, for example. And then when that bubble kind of pops and the demand has to move and supply has to move, the hard part is the structure of the supply is not able to adjust rapidly enough to reallocate resources across sectors, labor and capital. And so we have a misalignment between demand and supply that can lead to a recession. So again, then the length and depth of that cycle, of that recession, of course, is going to depend on the permanence of that demand shock and the appropriateness of the policy response. So again, that's what I think are the things that drive recessions. And again, so what we're going to do in some ways is now think about recessions and what the data has looked like over, say, the last year. So here's some data. Again, this is kind of the conception that we have. If you go back to the start of the year, most people, pundits, had predicted that we were almost certainly going to head into a recession this year. Yet, now we're into October, late October. It's pretty clear we will likely not be in a recession this year, and we might have a slowdown in Q4, but there doesn't seem to be much of a recession forecast coming up. So let's talk about why that's the case. And if we think the demand sides are driving things, what I'm going to do is I'm going to focus on the drivers of what would cause a recession. And again, one way to frame it and think about this is we're going to break GDP down into the expenditure components. And again, remember that consumption's roughly 2/3 of GDP, investments 20%, government spending's 20%, and exports are kind of net zero. So again, when you think about that this way, it kind of helps us then think about how these factors contribute to growth. So again, GDP growth is a combination of these components, and it's a weighted average. And so we're going to go through this in a little bit more detail than what I have done in the past. If consumption accounts, say, for 2/3 of the economy, and if consumption grows by 3%, then we would say consumption's growth accounts for about 2 percentage points of GDP. We take a share of GDP, that 2/3 times 3, and we come up with that 2%. And so we're going to do that for several of the components and kind of look at things both by period, then over a longer period of time, and then by each of the components. So if I look at last quarter's GDP, what you kind of see here is consumption added about 0.5%, government spending added about 0.5%, and investment added almost a full percent to GDP growth in that quarter. But that isn't how it is each and every quarter. If I looked at 2020, the quarter one of this year, consumption added 2.54%, excuse me, and investment knocked off 1.7%. So investment growth was negative, government spending was positive, and net exports was even a little bit more positive. If I looked at Q4 of 2024, this looks like almost equal contribution from consumption, investment, and government expenditures. The net exports was a smaller player. Again, in Q3, you had investment knocking off a fair amount, consumption adding about 1%, and exports were adding quite a bit. And you could do these for the next 2 quarters. And I think what makes the next 2 quarters somewhat interesting were those were the 2 quarters of negative growth. And there are a couple stories that went behind both of these. The big driver, and you could see in 2022 quarter 2, was investment. What happened that period was inventory investment, which is the most volatile, had a big negative change. And because it was inventories and those fluctuate a lot, most economists looked at that and said, that's pretty fluky, and they downweighted that negative number. In a similar way, you had a big negative number in quarter 1 of 2022. And that was really driven by the negative exports. And again, an interesting story, what happened there was we had all of those imports sitting out on containers out in the ocean, and then we sped up the processing of those imports. And because we did that quicker, imports were much bigger, and that was the negative effect. Again, seeing something like that led the economists to believe that that big negative number was more of a data aberration than actually a real number. So while everyone was talking about the 2 quarters of GDP growth, they seemed to be kind of fluky points in the data, and economists, that's why economists were tapping on the brakes of actually calling that a recession back in 2022. So I've gone on too much about those kind of slides, and I'll skip that next one. So I'm going to break it down into components. And as you could see from those last set of slides, at least if you could kind of grab that mental picture back in your mind, consumption growth is probably the most static, the one that kind of seems to very rarely go negative, and is always adding somewhere between 0.5 to 1 to 2% of that contribution to GDP growth. And you see that same thing over time from 2000 up until 2023. Again, last period added about 0.5%. What's notable here, again, that how much consumption has added to GDP growth over, say, the last 12 quarters, again, coming out of the pandemic. And so, again, one of the questions is really one of the big drivers of GDP growth has been consumption. Why is that? Well, I think we know a lot of the reason now. If you look at real disposable income during the pandemic, and then what this kind of helped things afterwards, unlike almost any other recession, real disposable income jumped up. What was the main reason? Again, as we all know, there were different forms of stimulus, whether it was PPP, additional help on unemployment benefits, other aids to families with children. All of that gave households additional disposable income. So when the economy opened back up, what we could see happening was consumption was able to bounce right back. And so kind of one of the things that, that's been in these slides and remains in these slides was why consumption was able to bounce back was because people had lots of disposable income. And then when the economy opened back up, they were able to go back out and spend, and that helped boost or move GDP along. What's new, I think, at least actually new in the last couple of weeks, one of the things that was helped driving consumption along were households had a lot of excess savings. Again, think of how different disposable income was from what it would have been, and their consumption kind of fell for a few periods. Going into the last couple months of this year, by most measures, this excess household savings was declining. And so drawing on this excess savings was helping move and keep consumption growing and help moving the economy along. And one of the big concerns that economists had what was going to happen when that excess savings was gone, because we also had some other warning signs that concerned us. We started to see a rise in mortgage debt. Consumers are borrowing more, taking out bigger mortgages. And we kind of saw that in some areas, again, around the country, as people moved out of urban areas to more rural areas. And then if you looked at other form of consumer debt, what you saw was that rising student loan that students are going to have to pay, former students are going to have to pay that back, and rising auto debt. And so we're looking at, okay, we're running down savings, driving up debt. Is that going to constrain consumers more? And is consumption actually going to fall, and one of the main drivers not be such a force anymore? Well, what happened just the other week, there was a revision to the data. And to be honest, I am not exactly sure where I stand on what I believe. Through the revision of the data, households no longer only have 339,000 of excess savings. It's back over $1 trillion. So again, if you look at the old numbers, at one point it peaked at 2.4 trillion. Now, again, it seems that it's up at still relatively high. So again, if it is the case that consumers have that much excess savings, again, they have additional resources to draw on to keep consuming and keep moving that consumption along. So again, that kind of wraps up the consumption side, except for this last point. The other main thing about consumption that was really different about the pandemic was, because you couldn't go out to restaurants, out to eat, go to the movies, go to concerts, the consumption of services dropped dramatically. And it's just up till now, we're about 5% over the trend line. What did increase was, again, especially when we came out of the pandemic, was because I couldn't go to the movies or I couldn't go to work. We bought things at home, goods at home, a new computer, a new TV, new stuff for the kitchen to make meals at home. The demand for goods jumped up dramatically. One of the things I thought we would have seen by now, as we are clearly open again, is that goods consumption would have moved back towards trend, but it is still notably higher than what it was before. So again, it's not clear to me why households are still consuming goods. But again, I think it's interesting to see what happens and how that evolves over time, this twisting of our consumption pattern away from goods to services. So that does wrap up the consumption side. If I switch over to investment, again, what you see is similar to what I showed in one of those the opening slide when we looked at things by quarter, that investment spending is a lot more volatile, both in terms of magnitude and direction, than consumption. In some sense, even though it's only 20% of GDP, it is the tail that wags the dog in terms of recessions. And what does investment include? Investment includes the purchase of plants, machines, and equipment. It includes those changes in business inventories that I talked about are volatile, and then the component that we forget about, residential investment. And the drivers of each of these components are different. So they take a little bit of explanation to go through of what I think is going on. We'll go through each of those briefly so that we understand probably what's going on the investment side. When you think about fixed investment, the purchase of plants, machines, and equipment, really what goes into that are managers thinking long-term about what the state of the economy is going to be. And if they think the economy is going to be doing well in the future, they're likely to invest in plants, machines, and plants, machines, and equipment. This ISM manufacturing index is a measure of the management's perception about what the economy is going to be like in the future. And so anytime it dips below that 50% line, that's an indication that the economy may be heading into a recession. In fact, I'll skip the next slide and just kind of tell you here that this measure here is typically a leading economic indicator. So this usually goes below 50 before the economy goes into a recession. So when it went below 50, people started to worry, uh-oh, maybe we are heading into a recession. But again, I should state, even though it goes below 50, it is not always the case that the economy goes into a recession. But every time we do go into recession, it leads the economy in there. So notice at the end, we've had a little bit of a kick back up. So again, it'll be interesting to watch to see what happens with that ISM manufacturing index. Skip that one, as I mentioned. If you look at inventory's contribution to GDP growth, and I think this is the one I think where we have more uncertainty around. Again, you can see that's even more volatile in terms of magnitude and size, and there doesn't seem to be any real long runs of being positive or negative. I think coming out of the pandemic, one of the big differences is how do firms manage their inventories. Prior to the pandemic, intermediate inventories were done in terms of just-in-time management. I think a lot of the supply side disruptions and concerns about political and economic relations in other countries have caused firms not to just worry about just-in-time management, but having other options. And so as they switch to just-in-case management of their inventory, it'll be interesting to see how this inventory investment changes over time. And then that last component is the residential investment contribution. And of course, that's household construction. And what you can see is that household construction has been negative for roughly the last 8 or 9 quarters. Even though the last couple quarters have been relatively small, not as large, and that is somewhat surprising given the relative jump or increase that we've seen in mortgage rates. So mortgage rates have gone up dramatically, and we see a corresponding drop in housing starts. Surprisingly, the residential investment is a very interest rate sensitive sector. So even if we're back to interest rates that we haven't seen since the early to mid 2000s, it doesn't seem to have as big of an impact on residential investment. But I also would think, and I think it's the case, and we'll see how it plays out, is we may be going back to a renormalization of interest rates, that interest rates aren't going to go back to 3%, that we're going to go back to the more historical average of 5 or 6%. And that's going to take some adjustment on the household side, both psychologically and financially, to adjust to those different interest rates. Again, some other things to watch in terms of the housing sector. I think things that are showing up is this orange line here. These are housing listings that have price drops. If you look at for 2023, there seems to be an acceleration over the last couple months, but there is a cyclical pattern for all years. It will be interesting to watch what happens kind of nationally with what fraction of houses on the market have price drops in response to the higher interest rates. I certainly see it in this area around here. As we look to move, that it almost circulates every 1 or 2 months that housing stock has increased, and they're dropping prices a little bit every month. So again, that'll give us some idea of what's going on in the housing sector. Also, though, again, I think coming along with some of the data revisions that we've seen, we've got some good news on the housing side, at least for those people who live in a home and may be looking to sell it. The current forecast for what's going to be happening to housing prices is now stronger than what it was prior to the data revision. So again, maybe we have a better housing market than we thought, or a residential housing market than we thought we had before. Again, because one of the issues is I'm less willing to move from my house if I don't get, say, not only the right interest rate, but also the right sale for the house. If the housing prices kind of readjust, then I think we'll have a more liquid housing market. Again, for the sake of time, I'm not going to spend much time on net exports. Again, that's going to depend largely on world growth. if GDP grows in the rest of the world, that makes our exports, people will buy more of our exports and we'll get a bigger boost. One of the things I think is interesting that I've taken note of is over the last 4 quarters is that government spending has added about 0.5% or more to GDP growth each quarter. And I went and looked at the data and said, what is driving that? And as it turns out, what's driving that primarily is state and local government expenditures. So that may be coming from grants and credits coming from the national government, but I thought it might have been coming from some type of expenditure from the Inflation Reduction Act, but it doesn't seem directly from that. But again, I think it's notable or interesting to see that government spending has been contributing to in a positive way to GDP growth over the last 4 quarters. And while I'm not going to spend a lot of time discussing debt, while we are talking about government spending, I think one of the interesting things to think about, the things that have evolved over, say, the last few months, is the rise in 10-year government bonds. Why is that a concern? A lot of other interest rates that mortgage rates or what I may pay for home or auto are benchmark off the 10-year security. So even as inflation is coming down, that 10-year yield on government security is going up. And so you might ask some questions why that's the case. And I think there's a few driving factors. One is the belief that the Fed is going to keep interest rates higher on the federal funds rate. So they're going to try to slow the economy down to kind of cool off things. And that will typically lead to a sell-off in bonds, lower price of bonds, higher interest rate. And the next two are interrelated. There's continues to be a growing concern over the path of the U.S. debt. When is it going to be sustainable? And the idea that also along with that Fitch downgraded U.S. securities, again, leading to a sell-off of bonds. Lower price on bonds means higher interest rates. So bond prices will go up. It'll begin interesting to see what happens over the next few months, as I think is what we're seeing now, again, as we see tensions around the world with political and economic instability. Typically, when those things occur, there's a flight to safety in terms of financial assets. One of the safest assets is U.S. government treasuries, U.S. government securities. So it'll be interesting to see what happens politically and economically in the global landscape. And if tensions increase, if there looks like an economic downturn, that means there'll probably be an increase for government bonds, increase the price of bonds, and that will push then interest rates down. So again, that's something I think that we can watch going forward. So again, quickly moving through the unemployment rate. I'm not going to say much about the unemployment rate. It's at 3.8%. Again, the unemployment rate is a mixture of who's in the labor force, who doesn't have a job, and again, the denominator and the numerator kind of change, and it's hard to make heads or tails of that. A couple of things, though, I think about the labor market and related to unemployment is the nature of where unemployment is coming from. So this is monthly job separations. And again, I did a break here where you had these huge numbers during the pandemic. Again, what are these numbers? That says every month, roughly 5 million people lose their job either through layoffs or through quitting. And so what you see is a little bit of a rise here in job separations. So that may be a concern. Are we heading in a different direction in terms of unemployment? And of course, when you look in and break it out of what's causing these separations and break it into people layoffs versus quits, you see quite a different result than I think what most people would anticipate. The blue line here represents layoffs, and for much of the end of 2022 into 2023, there were lots of newspaper headlines written about tech sector layoffs, and I think that got people really worried that, oh, here come all the layoffs. Well, remember, the tech sector is a relatively small part of the overall economy. And when you look at the total amount of layoffs, it was very flat and even was somewhat downward trending. So again, the increase that we've seen in separations isn't coming from firms laying people off. In fact, it's coming from quits, which we actually think is a good thing because individuals are more willing to quit their job or leave their job if they have a better job to go to, or they think that they're a better job prospect. So underlying some of those unemployment numbers, and we're worrying about recessions and we're worrying about layoffs, there was nothing really in the data that indicates that layoffs were heating up and we should start worrying about the recession. It was just the opposite. A robust labor market was leading more people to quits. So if we look at what's happened over the last 41 months in terms of job creation, we can see each month that roughly coming out of the pandemic, a fair amount of jobs have been added. In fact, we lost roughly 22 million jobs in the pandemic, and now 41 months later, we've gained more jobs that were lost in those few months. And again, what we're starting to see and what we have is that while we've had more or less positive job growth, again, we're getting some indication that the labor market isn't overheating. How do you see that? In 2021, the average monthly gain was roughly 605,000 jobs per month. In 2022, it was 399,000. And last month, eye-popping, surprising number of 336,000 jobs, new jobs created, pulled the average up to 259,000. So again, we're still adding a fair amount of jobs each month, but the rate of increase, kind of average rate of increase, is going down. Again, maybe coming up with some idea that maybe the labor market isn't as overheated. I'm going to come back and talk about that, maybe give a little different view of that in a second. If you look at employment gains by sector, the biggest gaining sector over the last 41 months has been leisure and hospitality. Not a surprise. It was also the sector that lost the most jobs, as well as the health sector and some of retail trade. And again, the best way to see and measure these job gains is by comparing them to the job losses that were lost during the pandemic. So again, it's still surprising that we haven't got all the jobs back yet in leisure and hospitality that we lost in those 3 months of the pandemic, the 8 million jobs lost. But other sectors, in particular the health sector, we've gained almost 1 million more jobs. Professional services, 1.6, a lot of IT jobs and other related jobs have grown in. Another sector that kind of sticks out if you live near an interstate is that transportation and warehousing, with the trucks going down and the new warehouses being built. We've had almost 1 million more jobs created in that sector. Even the manufacturing sector has more jobs net than where we were before. So again, if you look at by sector, you can see that we've done pretty well, especially in health services, in professional business services, and transportation, warehousing, and manufacturing. And again, also, I think what's interesting, and again, if I did these numbers correctly today, which I think I did, I computed the change in weekly earnings, and this is not hourly earnings. So this is relative to where we were in 2020. And again, it probably isn't much a surprise. Those individuals that had the fastest growth in terms of their wages over the week were leisure and hospitality. Next was education and health services. Again, that's not much of a surprise, I think, because those were the sectors I think that were in the highest demand. Still today, in terms of leisure and hospitality, they're still trying to find workers. So it's not that surprising when the demand is high and maybe the supply isn't as great. Those are the ones who are going to have the highest growth rate in wages. And you can kind of see the overall in terms of private sector wage growth has been about 13%. It's been quite modest in retail trade and information. Again, one thing that you could think about, if you even broke this out a little bit more, the one thing I also think that you see in this data is that within these sectors, the sectors that we think have the lowest paying wages were the sectors that had the highest wage growth. and the sectors that had the highest wages typically had a little lower wage growth. So again, if one of the concerns was about income inequality, the growth that we've seen coming out of the pandemic has kind of mitigated that. And one paper I read is if you look at the 80-20 differences between the 80th percentile and 20th percentile difference in terms of income, the pandemic wiped out about 20% of that difference that accumulated from 1980 to 2020. So again, in some ways, the last few years have reduced income inequality across groups. And I think that's interesting. Of course, one thing is to look at income wage growth, but it's also important to compare it with inflation. So over here, same graph. Now I've drawn in how much prices have risen in terms of the CPI from May of 2020 to where we are with our current measures. And you can see, with the exception of leisure and hospitality, real wages of almost all of these other sectors are lower than what it was. So while our wages are rising, prices have increased a little bit faster. And again, what we would hope to happen in the next couple of years is even more correction, that wages catch back up with that overall rise in the price index. So going talking about inflation, one more thing about measuring the labor market. Instead of measuring unemployment rate, you can actually measure the level of unemployment. And another thing that's interesting to compare it to is you can measure job market tightness, is you also look at number of jobs available and vacancies. And in the way economists look at this kind of labor market tightness, they look at the vacancy to unemployment ratio. And the way, again, the way you think about this or should see it is if this number is going up, it's a tighter labor market. And as if number goes down, that means it's a more slack labor market. And again, what that means is when vacancies are high, there are more firms competing for each worker. That's a tight labor market. And what the Fed can worry about in those instances is that going to induce pressure on wages? Is that going to push up wages quickly? And how quickly do those wages push through and maybe cause additional inflation? So let's turn to inflation. Skip that one for the sake of time. And again, as I stated at the outset, inflation's on its way down. Back in 2022, inflation had been the highest it's been since the mid to early 80s. But again, through the actions of the Fed and some of the corrections that have occurred in the market, inflation is headed down. So a question I always get is, what caused the run-up inflation and what's causing the reduction? So a quick 3-minute explanation of what's going on. One, of course, has been supply chains. And this is the New York Fed's measure of supply chain pressures. And what we can see is the supply chain pressures are down quite a bit from the pandemic. That means a lot of those supply chain pressures have kind of worked themselves out and goods are moving more freely. But it really couldn't have been all supply chains, because if you look at containerized imports coming in, during the pandemic, we were actually bringing in more imports, more goods than what we were doing beforehand. So there was some supply chain issues, but what was going on in the goods sector? And the issue that, again, I'll come back to was exactly what was happening with people's consumption. As we tilted our consumption to goods, as I was buying more computers, stereo equipment, home, kitchen appliances, it was more difficult for firms to ramp up, maybe because of supply chain issues, maybe because computer chips were going to computers rather than to autos. That was causing issues on the supply side in the auto industry. There was difficult to adjust in terms of production. And when there was an increase in demand and you can't make a quick adjustment on the quantity side, it's going to show up on the price side. And that's exactly what we see here. This blue line here depicts goods inflation. This kind of Batman diagram here. And what you see coming into the pandemic was this big increase in demand led to a big increase in goods inflation. Whereas service inflation kind of held constant, but then after time, that goods inflation bled into service inflation. And what the Fed is worried about now is that sticky high service inflation. When inflation on services goes up, it comes down a lot slower. And remember, services are about 70% of what we consume. So even if there was zero inflation on goods, there's still 3.5% inflation overall, 0.7 times 5%. And again, that's above the Fed's target of 2%. So the Fed's got more work to do. Again, what was the other causes of inflation? It was the growth in the money supply. Again, rather than in 2000, where the Fed injected money into the banks and the banks held it. So you see here no real increase in the money supply because the money went into the banks. Banks held on because they didn't want to hold mortgage-backed securities. That money never went into circulation. It never became inflationary. In the pandemic, as the government increased its stimulus, those checks, rather than going into the vaults of the government, were going into our checking accounts. If we were getting more money, what are you going to do once you're more cash liquid? You're likely to spend some of that, and that was going to be inflationary. So kind of a last thing that people talk about when it comes to inflation is if you look at inflation kind of in the current experience and you compare it back to this red line here, kind of dotted line, that red dotted line was the path of inflation from 66 to 1977. If you kind of run that out, fast forward that, looking out, what happened in that period from 67 to 77, inflation started to go down, and then right around the late 1970s, it started to jump back up. And one of the reasons why, there were a multitude of factors why, but one of the reasons why, as inflation started to head back down here, the Fed decided, okay, let's ease off of that high federal funds rate and start bringing interest rates back down. Again, that became more inflationary, and with a couple other things, that pushed inflation back up. So that is one of the things that the Fed is worried about, is taking the foot off the brake too soon and then adding more fuel onto the fire. So again, you could see here in that picture from 67 to 76, the Fed quickly brought the federal funds rate down, and then that ended up being more inflationary. So again, let's kind of end up again, as I mentioned, next week. Tomorrow we get to hear the GDP number. Next week, we'll hear what the Fed says. Again, consensus believes that the Fed isn't going to raise the interest rate. They're going to hold it constant. Everything indicates that way. So again, the outlook, it looks improved in terms of commodity prices, supply chain movements, interest rates are cooling. The money supply has all been declining, but they're still above that core 2%. So while they may, again, not increase interest rates now, they'll probably have something in their language warning about maybe future rate hikes, especially if we get this hot GDP number coming in. So again, ending with the summary I started out with. So again, things look good, especially I think things will look really good tomorrow. But again, you have to worry about the headwinds of the political and again, potentially economic international issues. But again, at home, though, we've talked about recessions quite a bit over the last year. The data has been the exact opposite. And I'll leave you with kind of what my quick take on why I think that's true. You know, one of the possible reasons is we all live in our own echo chambers now, whether we're watching MSNBC or Fox News, for example. And if you watch either of those channels, both of the channels are political pundits will say how, if it's Fox, how the Democrats are going to run the economy into a cliff. In fact, it's already into a cliff in terms of inflation. And if you're watching MSNBC, they're telling you how dysfunctional the Republicans are and how they're going to run the economy into the cliff. In fact, they're already doing damage to the economy. And so as I think we become narrowly focused in those echo chambers, it's all we hear, the negative news about the other side. But when you take a cool, hard look at the data, it doesn't look nearly as bad as what we're getting from our local news, somewhat biased, not local news, but biased national news in those echo chambers. Okay, I'm going to take a breath now. All right, so any questions?
I've got a question for you, Scott.
Sure.
I watch the stock market, and I've always thought that the stock market is something that's looking to the future. And it seems that the market has been, it's not going up. I guess it's not going too far down. but at the same time, we're hearing from your talk that inflation's going down. It seems like the economy is getting better, but the stock market maybe suggests it's not. I don't know. Am I reading
Yeah, so
my
I think,
assumption of the market
part of
wrong?
that yeah, I think that's right. And I think, you're correct in saying that, the belief that the stock market is kind of the longer run view of where we think the economy is heading. And again, I think what we're seeing is, while the economic numbers look good, and the forecast, I think, have all been a little bit on the cooling side. Again, I think what we moved from was a recession to not a recession. What does that mean? You would get some modest improvement in the stock market from that. But also, I think we're seeing a rebalancing of some of the liquidity that was sloshing around. We've seen quite a big, quite a relatively dramatic reduction in the amount of money, and some of that, I think, may have that the amount of money that was in the economy may have led to higher asset pricing, that once now it's getting drawn back, that may have a little bit of a deflationary pressure. But no, if you would just look at the numbers, I probably would agree with you that you would expect the stock market to be doing a little bit better, just based off of the economic numbers relative to what we were forecasting at the beginning of the year.
I was just curious. Anyone has any other questions, feel free to put them in the Q&A, or you can just drop them in the chat as well. Like we have a quiet crowd today, Scott.
Yeah. I hope they're all awake still.
Is it my other question, Molly, do we have the Q&A feature? Is it activated?
I see it.
All right. Okay. Someone just popped in a question. Phew. Oh, laugh out loud. The chat is disabled. Oops. Well, we know the Q&A. Q&A works. Phew. So what do you think, Scott? Are we I mean, I know you're not paid to think in the future, but just kind of when you're looking at the data, are we heading to a recession, or do you think we're gonna?
As I did the talk throughout the year, so again, January is kind of that December, January, the kind of the heavy part of the year where I probably do about 20 of these. I think all of my the slides there were very negative and very pessimistic. And then we moved to kind of February-ish, and the numbers started to improve, but then all of a sudden we got hit with kind of the regional bank issue, right? And then that again led to some of the worries about are we heading into, are we going to have a lot of regional bank failures? Is the Fed going to have to bear those again? So then the slides are almost all about that, and you started to worry about, a financial crisis-induced recession. But then since then, again, the regional banks, I think, do have some weakness to them still, because again, their assets and liabilities aren't quite well aligned. But most of that concern has died down, and then almost all the other numbers seem to be consistent with a at worst neutral view on the economy. So I think fourth quarter, will be about 2%, and next year probably overall it'll be about 2% growth. Again, always something can happen, again, especially in what we've observed the last few weeks, that can cause it to go either way. But again, the numbers are neutral to positive. So if we think that that longer run GDP growth of the last 20 years of 2%, that's what I'm going to bet the rest of this year and next year.
Yeah. I have a question here from
Don't
Mary.
use my anyone out there, don't use my forecast for betting.
You're not a licensed broker. Mary is asking, what do you see as the biggest area for growth in the U.S. economy heading into yet another post-pandemic year?
Yeah, so that's always the tough one. Again, when I think about growth, again, as I think about the drivers on the supply side, and usually when you have how growth sometimes works, and I think growth spurts sometimes work is you have a big innovation in a certain area, and that has a tendency to ripple all through the economy. So you can think of electricity, intercontinental highways. You have even something like the dot-com boom, again, the internet, even though there was a bust associated with that. Those are relatively big innovations that started in a specific sector and rippled through the rest of the economy, leading to overall growth. It's always hard to predict where those coming from, but I think what we're seeing interesting now is how we harness this AI revolution. I know I use it on almost a daily basis. It's enhanced my productivity tremendously, because some of the more mundane tasks that would take me 45 minutes to an hour to do, I get some AI assisted work, and it cuts it to a third. So depending how businesses harness AI, that could be one of the drivers of growth, and what sector it gets utilized the most and is not obvious to me, but I think it has some real potentials for spurring some growth, but also might be disruptive in some ways, and in some occupations may be more difficult. Some occupations may be put in jeopardy. But again, that's where I think the growth is likely to come from, the tech sector, kind of AI, over the next 5-10 years or so.
So Michael is asking, does the Department of Labor track those working on-site versus remote? And if so, do they or the Fed use that data to model, predict, I guess, varying impacts on regional economies?
Yeah, they do track some of that. I don't in any of my talks. And that's an interesting question of how that would impact regional economic activity. I think what you're seeing is the employer side of the on the labor side has realized that some of the work from home, it really is difficult to do. There were some benefits, and I think through the pandemic, there was some boost in productivity, but there is something about having people in the office and working in an office, seeing other people working, running into each other in the halls, discussing things, hammering out problems that are more difficult to do remotely. So most people that I talk to, and talk to a fair amount of people, on the business side, are pretty adamant about getting workers back into the workforce, at least, that the work from home, kind of reducing that. That said, though, I don't think that, in most kind of like white collar jobs or office jobs, I think in terms of attracting workers, I don't think you can get workers unless you offer at least some type of work from home option, whether that's one day a week or more flexibility. So again, I think productivity could be enhanced by a meeting of the minds in terms of when you're going to be back in the office, what bosses want, so to speak, and what the workers want.
I think Michael had raised his hand. I'm going to allow him to talk real quick and see if he's got a follow-up question. Hey, Michael, I think you can talk if you want. Maybe I didn't do it right.
I think you asked me instead, Mary.
I'm sorry, Mary.
You there?
I see Michael now.
Okay. Can you hear me now?
Yep.
Okay. Thanks. Sorry about
We
that.
said no. Would you believe us?
Yeah. So, Scott, I was asking that question. Yeah, certainly beyond the productivity considerations, I have a lot of managers who have echoed the same sentiments you had just echoed about the concern about worker productivity and trying to get more of them to work on site. What I've seen and what I've heard, I live in Boise, and so what I've heard, it's my sense is, and again, this is anecdotal, is that it seems like that the remote opportunities are increasingly available to those white collar service workers who are more maybe in the middle to higher levels of the organization rather than lower levels of the organization. And there's a lot of people here, specifically in the Boise, I talked to some realtor friends who say that, this has really altered the housing market beyond some of the other factors you mentioned during your presentation, the Boise housing market of the last few years. And so I was wondering more from a macro regional level, are they going to be tracking these kinds of changes in worker locations, maybe dislocations, and how that might impact, the major housing market, for example?
Oh, I think I think that certainly is an issue. And I think they are going to pay attention to it. I know, I live in a somewhat rural area of South Carolina, but it is attractive in some ways because we live in the foothills of the mountains and we live on what I would argue, and maybe you would argue with me, on three very nice lakes. And what we've seen happen over the last couple of years is a fair amount of people from New York, in particular New Jersey, and other more urban areas have moved out from where they work, and they work remotely from either in our neighborhood or they live on the lake, and they fly back once a month for a corporate meeting, and this is common as well, the headquarters will have a weekend getaway, kind of a weekend, doesn't necessarily have to be a weekend, but let's call it one, getaway in a resort type area where you go work for 2 days and then resort for a couple days, and then everyone goes there. So yeah, I think your anecdotal evidence is consistent with my anecdotal evidence. And I think it's going to be interesting to see how the housing market develops, regional housing market develops, and what happens to kind of core urban areas. In some ways, if you get some deurbanization, maybe that will alleviate some of the housing problems that we have for middle and lower income individuals, maybe, if these get converted into something else. But it certainly is something that happened to the pandemic. And it's certainly, I think, something that the BLS and the Federal Reserve is trying to keep track of. That's a great comment.
All right, we need time for one more question, and then we'll let Professor Baier go so we can. It's already kind of late for you, 8 o'clock, huh?
Almost my bedtime now.
Yeah. All right, well, if there's not any more questions, thanks so much, Scott, for your time again. Really appreciate it. And then if everyone, the participants, if you can just take a moment to complete the survey. Part of the survey, of course, is just we're looking for other topics that might be of interest. So please fill out the survey and let us know. We're always trying to figure out things that will advance economic education and will be of interest to economics teachers. So thank you everyone for participating.
And I want to thank everyone for coming out either earlier in the afternoon or relatively late in the evening, depending where you're at. I want to thank Ted and FTE for again doing this. I think it's a great service. And I hope you look to see what else they're doing, because I think that these are always fun to watch and you'll learn a little bit from them. So again, thanks, Ted. Thanks everyone for coming.
Then Scott, I'm going to be waiting in anticipation for the results tomorrow.
I was curious to see if it comes in at 5%. I think there'll be quite a reaction tomorrow.
Yeah. Well, as I'm getting closer to retirement, I'm hoping the reaction is a positive on the market.
Yes, that's right. Yeah. Me as well.
Yeah. All right. Well, thank you, everyone, and good night.
Thanks.
Thank you.